In this video for A-level business students, we're going to be looking at the topic of statements of financial position, or as they're more commonly known, balance sheets. So whether your exam board refers to these documents as statements of financial positions or whether they simply call them balance sheets, worry not. They are exactly the same document, and along with an income statement, they make up what's called a business's annual accounts. Now, whereas an income statement is a summary of the business's trading performance over the last 12 months and will display how much profit or loss the business has made, a balance sheet is different. A balance sheet is a way of recording the business's assets and its debts. What does the business own and how much does the business owe? Except in your teaching, you will have seen that we don't refer to a business's debts by that name. Instead, we call them the business's liabilities. But it's essentially all of the debt that a business owes to other organizations. Now, for your exams, it will be useful to understand how a balance sheet is constructed in case you're asked to do any calculations within them or just use them to help you calculate some of the financial ratios that you may come across in your examination. So the first thing to look out for are 3 zeros that might be at the top of a balance sheet. That just denotes that whatever numbers you see in the following document, you add 3 zeros to it. And it's a common thing used by most of the exam boards. But let's talk you through how a balance sheet or a statement of financial position is constructed. The first thing that you will see in this document is a list of the business's assets, except those assets will be divided into 2 categories. Basically, we're going to split everything a business owns between the items that it's probably going to own for a long period of time, which we call the non-current assets. That might be things such as property that the business owns, like factories or offices. It might be vehicles or equipment or machinery that the business has purchased. All of these items will count as the business's non-current assets. And then underneath, you will also see an item in a balance sheet known as the business's current assets. Now, these are still things that the business owns, but they're items that the business might not expect to have in 12 months' time. It might be things like cash that the business has in its bank account. Maybe it's money that the business is actually still owed by customers that it's given trade credit to. It might even be the stock that the business has in its warehouses or on its shelves. All of these assets will probably have moved out of the business within 12 months. But the non-current and the current assets are essentially just a list of all of the assets or the items that the business owns. And the next item that we will put on a statement of financial position is to add the total of all of these assets together. We're going to take the non-current assets and we're going to add them to the current assets to get a grand total of the value of all of the business's possessions. Before we get cracking on the business's debt, we start off by looking at the current liabilities this time. These are all the debts that the business has that are going to be repaid within the next 12 months. This might be things like the business's overdraft that it has with the bank, or perhaps any money that the business owes to its own suppliers for stock that it might have purchased on trade credit and not paid for yet. Underneath the current liabilities, we'll then have an itemization of the business's longer term debts. This could be things like bank loans or mortgages that the business has that it still has to pay off. And obviously those debts might be quite long term, so may take longer than 12 months to pay back. Then, just as we did with the business's assets, we're then going to add all of these liabilities together. We'll take the current liabilities, add it to the non-current liabilities, and it will get a total of the business's debts that it has, so we can assess the value of the business's assets compared to the value of its liabilities. Now, when we do that, it's known as calculating the business's net assets. If this business has total assets of £6 million, but it has liabilities that come to £4.5 million, then the net asset is just the difference between those two figures. But that makes us pause for a moment, because how on earth has a business managed to accumulate £6 million worth of assets if it's only borrowed £4.5 million to pay for them? How can a business afford to buy £6 million worth of possessions without borrowing £6 million to pay for them with? Well, the answer is that money must have come into the business to pay for these assets from a source other than borrowing. And the final thing we'll show on one of these statements of financial position is how extra funds have been raised by the business to pay for its assets. For example, the business might have sold some shares during the course of the year, and the share capital that it has made from those transactions may have helped pay for some of the business's assets. Also, the business might have decided to retain some of its funds or its profits in the organisation that it's made in previous years. For example, if this business has sold £1 million worth of share capital and has got retained profits of £500,000, then we can total these two items together, which is known as the business's total equity, and you'll see that this comes to £1.5 million. Now, that £1.5 million is the additional funds that have come into the organisation to pay for the assets that the business has procured during its lifetime. So we can see that these documents are called a balance sheet because two of the items on them always have to be the same. The business's net assets, that's the difference between the value of everything the business owns and the value of all the debts that it owes. Well, that difference is paid for by the total equity that the business has raised, the money that's come into the organisation either through the sale of shares or from retained profit that the business has. So hopefully that quick run through will help you understand how a statement of financial position or a balance sheet is constructed. It's possible you might have to view one of these documents during your examinations to help you with your calculations. We will see you very soon because we're going to make another A-level business revision topic the focus of our next tutorial.